Amex Exploration has updated the market with their preliminary economic assessment on the Perron Gold project in Quebec. Now we're talking about a 70% return on investment and over $1 billion in net present value. But what's really interesting is their two-phase development strategy that could have them producing gold by 2028. We'll dig in a little further with CEO Victor Cantore. Victor, these look like strong numbers here through your PEA. Can you walk us through highlights first?
Yes. So definitely the price of gold is, at record highs. So we implemented a staged approach. It becomes technically and fiscally responsible to do it in a staged approach. It's very prudent. You're going to be minimizing your permitting, your technical risk. You're actually lowering it because you're going to be mining it. You're gonna understand the rocks, the way the rocks are behaving. You're going to understand how much you're gonna be milling. A lot of the common errors that happens in a mining project is they don't size the mill properly, where in this case you're mining the Champagne zone for 4 years. You're going to be able to size this. You're going to be able to size this properly. And the staged approach, what that does, it reduces your upfront capital. Again, that's where it becomes the financial part, where it becomes really interesting. These are quite impressive numbers. Like I know we've been showing the base case, but when you actually start showing the economic analysis at spot price, and we use spot price at $3,400 and $1.38 for the exchange rate, the numbers start getting really attractive. If you look at the pre-tax total free cash flow at spot price is $5 billion. That's billion with a B. Your post-tax NPV goes to $1.8 billion. Those numbers are quite impressive. Your post-tax after-tax IRR 107.6%. And also one of the other financial metrics which really talks about de-risking a project. There's a mining project. There's two things. There's your post-tax payback period, and at spot price, it's 0.4. 0.4 is what, 5 months? It's less than half a year. And when you look at your ratio of post-tax NPV to initial capex, at spot price is 13. A normal ratio, like a ratio that passes that it's a good project, is 2 and higher. We're at 13. We're more than 6 times the metrics of a project being positive. So yeah, it's really very exciting seeing all these numbers. It's quite impressive.
And when we look at your all-in sustaining costs, it's at $1,061 per ounce, US dollars, which is notably competitive in the industry. What advantages does the project have that allows you to get these cost levels?
It really comes to high-grade gold. And it's not just high-grade gold, it's high-grade gold and where it's located. Like from Montreal or Toronto, you can drive up there and take you 7 hours or so. You're right beside the city, the town of Normetal. You have water, you have electricity, but most of all, you have manpower. You're not disturbing any lakes, any rivers. Our project is really clean. We're really blessed to have this project where it's located.
And what's your capex for phase 1? Can you review that for us as well?
Yeah, it's the capex for phase 1 is only $146 million. It's not a high amount, especially for a mine where you're going to be producing. The average is in the first 4 years, it's 102,000 ounces of gold. With an all-in sustaining cost of $1,165. We're also going to be getting pre-production credits from gold sales of $68 million, which will lower the capex. The capex is going to end up being lowered to $77.5 million from the pre-production sales.
Well, if we, talk about timing, you're coming out with the economic study when gold's hitting another fresh record high, and we know that, timeline-wise, you're targeting 2028 production. How much are current gold prices factoring into your development timeline and strategy to keep financing?
Yeah, absolutely. So, well, we just completed a financing of 37.25 million dollars. Gold prices definitely really helps in moving this project forward. You want to become a producer as fast as possible, and the strategy that we're implementing is we're going to start with a bulk sample first, and the bulk sample is going to be a production size decline. So your decline, your portal, it's all production size. So we're going to be filing that permit very shortly in the near term future. It's what here they call in Quebec an ATI. ATIs usually get permitted to 3 to 6 months. So I'm really expecting this to get permitted sometime in early 2026, and then it would take it as you get that permit, it would take you 1 year of construction. But then if you come back to this, we're going to be filing we're working on a feasibility study. The feasibility study is that should be completed sometime in early 2026 also. And once that is completed, that triggers your permitting process. So your BAP, that usually takes about 2 years. So sometime in 2028, we will be permitted. We're expecting to be permitted. Now the difference is the fact that you built a production size decline. You don't need to wait for construction. Usually you get your permits and then you start construction. Now because and you're going to have that year of construction. Now because we built the decline already and it's a production size decline, we're going to be able to go sometime in 2028 go straight into production, assuming that all the permits come within those timelines, which usually those are pretty much the same timelines. And that's why we're doing a feasibility study only for the toll milling first, because that's how you can get a feasibility study done quite quickly.
All right, Victor Cantore, thank you for being here. That's the CEO of Amex Exploration. You can find full ticker symbols below. And of course, go to CEO.CA to check out what other folks are saying. Thanks for watching.